So we need to come up with a title for the video. It needs to be something like the Bank of England have completely f***ed up everything.
Why don't you just use that?
We can't use that one. Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. And in today's video, we're talking about today's release from the Bank of England that interest rates are going up by 0.75. And I'm asking myself, are the Bank of England trying to crash the UK housing market? Because quite frankly, it looks like they are. And the Fed in their releasement yesterday, interestingly, we're talking about how the housing market in the US has overheated and they want to see that start to come back in to normal. I am paraphrasing slightly, but into normal supply and demand dynamics. So the Fed are not too worried about the damage they're doing to the US housing market. I wonder whether the Bank of England are taking the same approach with the UK housing market. And I've got £3.5 million worth of property with £1.7 million worth of debt on it. This matters to me. So before we get into the video, I just want to remind you we have the subscriber dividend portfolio. If you want to be in it with a chance of winning that, please subscribe to this channel. We don't do any upsell. All we try to do is bring you as much information as we possibly can, completely free of charge. And because there's no upsell, I don't need to hold anything back. There's no course to buy, and we even try and pay you for the privilege. So every month I put an extra £1,000 into there, and then we pay out the dividends to our subscribers. But let's get into the information. Let's talk about what's going on. So the Bank of England have increased the rate by 0.75%. It was widely expected that that would be the case as well. So there's no big surprise here. The base rate is now sitting at 3%. But what I have done is read through the minutes. I just picked out some bits that I thought we could talk about. For example, one of the things that I found really interesting, but the Bank of England expect GDP this quarter, Q3 in 2022, to turn negative. Now, from what I'm seeing in my businesses as well, I believe that's going to go forward into 2023, i.e. Q4, 2022, 2023, and it will probably mean that we go into a technical recession next quarter. Now, that is then carried through in quite a lot of the detail that they've written in the minutes. For example, they believe that weakness is a fall in real household incomes. Well, of course, you're raising interest rates, you're making mortgages more expensive, you're making borrowing more expensive, used cars, new cars, all the sort of things that you finance within the middle class and the people who are aspirational. Those are the people that are being hit the most. The rich, the savers, the pensioners, generally speaking, they've paid off all their assets, right? So they're not being hit anywhere near as much. In fact, they're having a net positive. For people like myself who've got debt, who are fairly young, who are growing their portfolios, we're the ones that are going to take the brunt of this. So the fall in real household incomes is being cited as a major reason for this fall in GDP. And I think ultimately, you're going to see more of that in the next couple of months. And that is why I think Andrew Bailey came out and said he expects the ultimate rate, the peak rate that the Bank of England hit will be lower than what the market expects. And the market expects around 5%. He says it will be lower. So I think they're going to have to pivot, if I dare to say that word, they're going to have to pivot earlier than people are expecting, because as soon as you start taking this amount of money off people and the incomes are not rising at the same speed that the costs are. If you look at, for example, we were talking about a Mercedes C-Class, and it used to be about £350 a month. Now it's £650 a month. I mean, that car is not attracting the same buyer anymore. There's no question in my mind that the same buyer can afford that car. And then if we think about mortgages and how they're going to be impacted, I mean, there's huge amounts of money coming out of that middle class bracket, and those are the ones that go out and spend. So I really think that this fall in household incomes is going to impact GDP faster than it's probably going to impact inflation. And that really is the Bank of England's quandary in all of this. Can they get inflation under control without destroying and crashing the economy and the housing market, which we'll get into in a minute? You know, I think again, rising interest rates, you're going to see a reduction in house prices. You're going to see rents up, of course, because ultimately landlords are already into their properties. They're going to need to make a profit on those properties. I mean, what new landlords coming into the market with rates rising? And you know, it's just not going to happen. I think ultimately speaking, house prices will come down, rents will go up, unless interest rates start to come down. So everybody's going to get squeezed. The renting population is going to get squeezed. The homeowner is going to get squeezed. There is a big squeeze going on here. The only people who are winning and sitting pretty are the rich and the people who paid off all their debt. I come back to that. Those are the winners. So they did talk a little bit in their minutes about some of the government responses. For example, 1.25% off national insurance. That's been kept. That was from Truss Economics. Rishi's kept that. The stamp duty reforms, that's been kept. However, we've walked back on the 19% income tax, the 20% 20% from April has been reinstated, and the energy price support is only in place up until April. But if you look at wholesale gas prices, they're starting to come down as well. Unemployment, 3.5%, lowest rate since 1974, 30 years record. All smashed. Ultimately, lots and lots of people are in employment at the moment. There's lots of jobs. The job market is very buoyant. And that does give the Bank of England a bit of wiggle room. They can push a bit harder than they might otherwise be able to if unemployment starts to rise. I think that's one of the key indicators to look at. But remember, most of these effects have a bit of a lag on them. If you put up the interest rates now, I don't suffer that today. If I did, £12,750 would come out of my pocket every year from next week. But I've got fixed rates that expire in 2023, 2024, 2025. I've even got some that expire in 2026 and 2027. We did one in August, I think it was, and in July, and yeah, August and in July. So we did 2 actually this year. So I've got some that expire a long, long way in the future, so those won't impact me anywhere near as quickly. However, there will be some unfortunate people who are coming to the end of their term right now, and I really, really feel sorry for those people that maybe went out, got a 95% mortgage on a property, they were looking at interest rates, they were low, 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 they bought in 2020, now it's coming around in 2022, they're leveraged up to the hilt, it's likely that their property is going to start decreasing in value, and that mortgage that was £1,000 a month is now £1,500 a month. That is an extraordinary amount of extra money to be able to find, and I really, really do feel sorry for those sort of people. And I think that's also going to come through on the data, right? Because those people are going to have no extra money to go out and spend. So we're going to have to see how it all plays out. Me, I think we're probably looking at a decrease in house prices. I'm not going out and buying anything today without a discount. I want a significant discount on price. Lots of predictions out there, anything from 10 to 30%. I think 30% is over-egging it personally. The biggest crash ever was about 20%, and that was in 2008. I know there was 32% in some areas of London, but 20% overall for the UK in 2008. I think if you rivaled that, I'd be surprised, but 10%, I can see that. So if I could get a 20% discount today, I'd probably buy. Last week we went out to the market, we had a word with some agents, we tried to put some cheeky offers in, no one was budging. It's not the right time yet. Right now, I think it's the right time to save some cash, get it on the sidelines, make sure you're insulated so that you can cover any extra expenses, because if it does get hairy and it does get risky, other people need to burn before you, you know? You need to make sure you're in a strong enough position that other people are hurting first, and then policymakers will be forced to make decisions and make things easier for everybody. So me, I'm putting cash on the sidelines. I'm going to look for opportunity to deploy that in the coming weeks, months, maybe even years. We'll have to see how long this drags on. But 0.75% up, I believe the Bank of England doesn't care about crashing the housing economy whatsoever. I think ultimately it went up by 10% last year, about 8% the year before, something like that. So we had big gains. They've got some headroom. We're not over leveraged. I mean, for example, in 2007, 2008, people were able to mortgage 100% of their debt. I mean, you just couldn't do that recently. Buy-to-let landlords like myself, we've had to put 25% down on most instances. I'll tell you what, guys, on Monday, I'm going to be releasing another video where we're going to be looking at the Halifax House Price Index. They are releasing their figures on Monday. I think we're going to start to see a drop there. And honestly, looking at the Rightmove figures, I can see that people are starting to reduce the house prices. Anecdotal evidence from agents, they're saying that demand from buyers is starting to drop significantly. It's all coming together as a bit of a perfect storm. House prices down, that's my prediction. Hold on to your cash, keep it on the sidelines, get ready to deploy. We're going to have an opportunity in front of us, possibly the opportunity of a lifetime. Like and subscribe, comment below, guys. I can't wait to hear what you've got to say about all of this, and I will see you on the next video. Cheers, guys.